Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. We got a lot of things to cover. We're going to kick off with some important news items that are coming out to make you a smarter investor, help you understand the economy. One big change that I'm seeing, and this is developing over time, will continue to develop, is can the Heartland states save our country? This is very interesting. When I pulled this out, I said, we got to talk about this because it is really amazing what is going on. Here's something else that it's the reverse of what you're hearing on the mainstream media, but consumer actions aren't matching what they're saying. So we'll talk about that. And our TV networks, while they're getting tapped out on sports deals, they do spend billions of dollars. And I always think about the advertisers have to support that. It looks like that could be coming to, I won't say an end, but they're realizing there's a problem.
Yeah, I guess the money doesn't go on forever.
It doesn't go on forever.
So we'll kind of talk about that here shortly. But companies we're going to look at today, a little company called NVIDIA definitely kind of took everybody's hearts by storm a few years ago. And, you know, it hasn't really moved much lately. We haven't looked at it in a while. So, hey, thought maybe now would be a good time to see maybe it's fallen back enough to be of interest to value investors. Also then, too, we're going to take a closer look at Hertz. Some interesting news there with Bill Ackman, huge increase in the stock price. Then we'll look at CarMax and Dow Chemical as well. It's just Dow Inc., but I still call it Dow Chemical because it's a chemical company. So as always, we'll break down the valuation ratios, the fundamentals, look at the balance sheet, give you an idea if we think it's a buy, sell, or hold, again, based on what we see here on the show today.
And you said they dropped the chemical? It's no longer Dow Chemical?
Yeah, if you just look online, it says Dow Inc.
Yeah, companies drop that last part. Sometimes it's confusing because it was nice to know it's a chemical company.
It's not the Dow Jones.
Yes, exactly. I mean, Dow's a widely used name. I don't know why they dropped that, but we'll talk more about that as we get to it. Let's start off with some of the main topics here to make you a smarter investor and help you understand what is going on in the world and the economy here in the U.S. Can the Heartland states save the country? Now, the Heartland states are about 20 states in the middle of the country. And again, these states are your main states. You don't hear much about them. But they've been regaining economic strength over the years. And I'm surprised by this number. About 39% of the U.S. population now lives in these states. And this is according to the Census Bureau from 2024. And what's actually going on, and you know, the coast, California does have beautiful weather, beautiful beaches. On the East Coast, you got New York, you got Florida. But it seems to be that businesses are saying, you're just too expensive to do anything there. We're going to focus more on the center of the country where we can build factories, get good wages for people, and get things done versus the West and the East Coast that are kind of, and I love living on the West Coast, but I think we're having a problem there.
I mean, you still look at, I think California by itself is the 5th largest GDP or something in the world, something crazy like that. I mean, so there's still a lot of population in California, in New York. I don't want to take that away. Florida's got a very nice population base there as well. But I was surprised by that. And again, 20 states at 39%. It's you know, a lot of states to occupy that amount. Like California is definitely more populated than any one of those states.
Yeah.
But I was surprised to see the population growth. Kind of, you alluded to this, but I mean, the numbers were quite interesting. I mean, you look over the last 5 years, you haven't seen this type of population growth in the last 65 years.
That's a long time.
So we're seeing good growth in the middle of the country there, and employers have really a big reason I think population growth is happening because employers in that area grew by 13.2%. So there's jobs in that area, and that growth occurred between 2020 and 2023. And business capital expenditures totaled $76.9 billion in 2023 and have seen an average annual growth of 9.43% since the beginning of COVID. So people, as you said, are investing in those Heartland states, which is, again, bringing people there because there's opportunity.
And I think it was, Monday, we had an earthquake here, which, you know.
I forgot about that.
And I bring that up because every region has their situations. And I mean, the Midwest, you do have tornadoes. You're always going to have something that's going to be a problem. And I just thought of that earthquake. And again, I've lived in California for over 40 years. And it's just, I don't say you become immune to it, but we were in an appointment and we felt the rumbling, started moving, like, oh. And I think it lasted, 30 seconds? Like, okay. And then you just go on. And and I'm just wondering, I say that, I think the tornadoes in the Midwest may be a little bit worse than that, I'm guessing, but I don't live there. But when I look at what they've done, they know they don't have the beaches, the beautiful weather. So they've established more business-friendly policies that will attract businesses and also tax incentives that they know these businesses will generate jobs and money and so forth, grant programs. This is all going to draw business to the area. And the East and the West Coast, they just can't compete with that affordability because they do have to pay the higher wage. I don't have any numbers with me, but I've seen these numbers where, in states like in the Midwest, Kansas and Idaho, the wages are lower. And therefore, a business says, well, wait a minute, we can go and get the same American worker there, pay less wages, less in taxes. They're going to give us incentives to move there. The building costs are less. The land is less. It's just like, as a business, like, why would you not go there?
Well, and it's not even just the business, but because, again, the affordability is lower. I mean, house here in California, a normal house costs $1 million, where a normal house in Kansas probably costs, I'm speculating here. I don't have the exact number. I'm going to say, $250,000, $300,000. You'd probably find a decent house for out there, I'd presume. So again, it's not even the fact that the businesses are paying you less, and I don't want to say ripping people off, but it's an affordable wage out there where they can still have a good life. They can buy things, but you live here in San Diego, you can't do that. The business has to pay you more so you can afford to live in the area. And, I think kind of to that affordability point, I was blown away by this. You talked about the lower cost for land, but also too, utilities are far less, being as much as 1/3 less than the rest of the country. I was like, wow, I wonder why that is. Regulations, maybe? I'm not sure.
I think it's a lot to do with regulations. And again, I think when you have a popular state, like Florida, and Florida's having its problems now because of the cost of home insurance.
Hurricanes.
New York, California, having some major problems because of expenses. Insurance is just outrageous in these states I just mentioned, and that is difficult for the consumer. And the businesses say, we can't pay you to start a wage of $40 an hour when we can go in the same place in Idaho, Kansas, whatever, and pay maybe $20 an hour because that person has, listen to this, a house payment, I'm going to guess around $2,500. I don't think there's a house payment in California at $2,500 for, again, average home $1 million. You can't even rent a 3-bedroom apartment. I'm
going to say a new home because, if you had a home, you refinanced it when rates were sub 3, you got people. A new home. Yeah, you're buying a new home, you're probably not going to find, unless you're putting a lot down on it. But, that's quite unique. And, I just look at it and kind of one example that comes to mind, and Arizona is not part of the Heartland states, but, like Taiwan Semiconductor. And I say this because I was out there and I saw the massive factory they were building out there.
Where is this at?
In Arizona.
Arizona.
And you're not going to do that in California. It's just too expensive. And again, we talked last week about these foreign companies maybe coming in, building factories. I think you're right. You're not going to see that growth, that boom in California and New York. Land's just too expensive. But who knows? Maybe we'll start to see some foreign companies come in and look at the Heartland states to find some good quality people, provide some jobs, maybe bring some people in there and, build factories out there for, some of this kind of repatriation or new capital coming in.
And we bring this up because it doesn't mean tomorrow, next month, oh my gosh, everybody's leaving California. Actually, though, California has gone down in population over the last few years, but this is a trend of people moving there. And it doesn't mean that California, Florida, New York, and have no people there. Then that's not going to happen. But what does happen is that you'll have less people, which then causes a problem because you have less revenue base for the state. I know California has some major problems. I think their debt is is it 60 billion now? Probably.
I haven't even looked at. California doesn't even have a balance sheet, so I don't know.
That's right. I remember that during the election. But it will cause problems, and also too, you have your kids, they grow up and hey, Dad, I'm gonna move to Kansas, and because they'll have the money to make cities nice, have nice homes and everything else. Where here, if you have declining money. And again, I'm talking probably 20 years that we'll see change. Because again, you said 65 years? It's been going on now.
Yeah, it's been interesting. And I'll tell you, we recently bought a company that does tools.
I love that company.
I think it's going to be a great thing, especially if we do see, again, more companies come in. They buy, up in that area. They need to manufacture there. It could be a great buy for us.
Yes, I think so. Well, let's move on to the next one, because this one here, you see the mainstream media like, oh my gosh, things are terrible, but they're talking about the consumer. We've seen the reports on consumer, what do they call it? Consumer
confidence, consumer sentiment,
all those, yeah, and just like wow, But then when you look at the real numbers here, which we've got for you, March retail sales, they climbed by 4.6% compared to last year. And gas stations, well, they actually fell 4.3%. We've been seeing oil decline, so gas prices decline. That fell 4.3%. So if you took out that decline in gas prices, you would have had an increase in retail sales of 5.3%. I mean, that's just an unbelievable number when you think, oh my gosh, everything's collapsing. We've talked a little bit about this before. You go to a baseball game, it's packed, freeways are packed. I mean, so there's a disconnect between what's actually going on, what people are doing, and what they're saying.
Well, I think a lot of it has to do with politics. It's like, I don't like what's going on, so I'm unhappy, and I think the consumer is terrible. And it's like, I still have money. I'm still going to spend money. I mean, because as you said, it's just not matching. I mean, you're talking about the worst consumer confidence, the worst consumer sentiment in months, years, and it's like. But yet retail sales continue to climb. And I do want to say this with a grain of salt, because there is some pull forward in what we're seeing, because people are worried about the tariffs. So there's definitely people, I think, buying ahead here. I mean, some areas that are likely more impacted by the tariffs, I mean, they did see large gains. I mean, motor vehicle and parts dealers saw an increase of 8.8%. I don't think if we were going to have these tariffs, I don't think you would have seen an 8.8% growth this month. And also, too, I was kind of surprised with this, but furniture and home furnishing stores, they climbed 7.7%. And after looking at Restoration Hardware's numbers, what was that, last week, the week before, we know that a lot of furniture companies have exposure to Asia. So I think people are also buying furniture and home furnishing items trying to get ahead of these tariffs. So those were two areas in particular that I think lifted retail sales, and then again saw that pull forward in demand here.
And and I did see last week we bought, because I always buy these pens to give out and for clients and so forth. I saw on the bottom line, tariff, $48. It's like, okay, well, didn't want to pay it, but I had to pay it. I still got the pens. So that is there, and that could be what is on people's mind. But, talk about the gains. I mean, they were across the board. They weren't just on a few things. And we probably did see a pull forward, as you said, but you're not going to have a pull forward on restaurant, food services, drinking places, because you're not going to eat twice as much or order two meals. You're going to come to eat, and you'll be back again the next time. But the drinking places and food services still saw a gain of 4.8%, which is pretty impressive. People are out there spending money. That's a good sign.
Yeah, and it wasn't even just retail sales that we got this last week. We also got numbers from American Express. We're not going to look at that stock today, but the CFO was talking about how American Express kind of spending cards, that rose 6% in the period when looking at last year, and then 7% when adjusted for the impact of the leap year. So, I mean, again, they're also seeing spending trends increase, but they said restaurant spend was up 8%. The numbers they were looking at. So again,
that was American Express.
This is American Express. And it's kind of talking about how the gains are widespread. I was kind of surprised by this. They talked about how there's a spending slowdown from some older Americans, but also a spending slowdown in airline transactions as well. But the category still grew 3 or 4% when adjusting for that leap year. So, I mean, people are still spending more money. It's not like people are spending, and I point out airlines as well, because it's the same thing as, the food and restaurants. You're not going to be like, oh, the tariffs are coming, I better buy my plane ticket now. That's something that is unimpacted by that. And it's just, I think, so important for people to understand that while these tariffs, I don't want to say are great for the economy in the short term, there's definitely some big question marks. The consumer is definitely coming from a point of strength.
Yeah, and I'm kind of guilty of that as well, because you bring up the airlines, and we're flying, I forget where we're flying to, I don't know, I forget. But it's just like, really? That's the cost of the ticket? Gosh darn it. All right, go ahead, pay it.
Yeah.
I mean, you don't like it, but it doesn't, I don't want to say, it doesn't break the bank. You'll do it, costs a little bit more. And I think that's what is happening. When you ask somebody something, they say, oh, yeah, this is terrible. but then they still say, well,
What are you doing tonight? Oh, I'm going to the Padres game.
Oh, okay. And I heard the Padres game, a ticket for the upper area, is that $60 now for a ticket? That's what I heard.
Possibly. I don't know. I haven't gone because my daughter, we took her once last year, and it was
Wait, your daughter's only a year old.
Yeah.
What are you doing?
We took her once last year, and that's what I'm saying. And it was a nightmare, so I'm not going again. It was way too much work.
Dad, should I take my daughter? Like, no, she's only a year old. What are you thinking?
She was 5 months at the time.
Oh, fine.
But I mean, we talk about this stuff, and I talked about how the consumer is in a strong spot, and we've looked at the numbers here. I mean, the consumer has relatively low debt. There's a low unemployment rate. And, Jim Cramer on CNBC, I don't agree with everything he says, but he's like, look, people are going to keep spending money as long as they have a job. And unemployment remains historically low. Even if we see an uptick in the unemployment rate, it's still really low. Like, oh my gosh, unemployment goes from, let's say, 4.1 to 4.5%. That's still a really good unemployment rate, and I think you will still see a strong consumer.
Yeah, it's off topic, but I got to say, because you brought up Jim Cramer, and I don't agree with everything he says as well. But you see, I think it was like Monday, Tuesday, he was almost crying, saying, "I gotta say it. You can't hold Apple. You gotta sell."
I did not see that.
He goes, "Don't sell all of it, but you gotta sell. You gotta sell it." And he was like, almost crying. Wow. Amazing. And we've been saying that for quite a while, but because he's been a strong advocate of Apple.
Oh yeah, own it, don't trade it is what he always says.
And now he's saying, "Don't own it, trade it." Well, let's talk about TV networks tapped out on sports deals. And I was surprised when I saw this here because I know they spend a lot of money on that. And I've talked about this for the past year or two. When is going to be the tipping point to where Coca-Cola and your sponsors say, no, we're not going to give you that money? And we know the salaries are extremely high in many sports. But Disney last year, they did sign a $2.6 billion a year deal with the NBA. But ESPN, who's been major sports, they've had MLB, Major League Baseball, for 35 years. And I don't know if you know the answer to this, but they were paying $550 million a year. And they said, we're done. We're not going to pay anymore. We're done. I thought that the MLB would be more than the basketball. I mean, basketball is almost 5 times, $2.6 billion a year versus $550 million. I don't know who's going to pick up Major League Baseball, but
I mean, I'm sure depends on the package that you get. Yeah. And I was kind of trying to look at the package a little bit. And this was supposedly mutually agreeable that both sides agreed to this. So it wasn't just
Disney, you mean?
On ESPN and MLB terminating the contract. And I was kind of looking at the package. It looked like MLB had Sunday night baseball, and then I think they had like the home run derby and some other things. So I'm not sure how many games they necessarily had for the MLB. And I was going to say, well, there's so many. It's not like the NFL where there's just 17 games in a season. But it's the same thing with the NBA. NBA and MLB both have a ton. So my guess is that the MLB package was much smaller than the NBA package that Disney got. That's probably why the price tag was much lower. That's just my speculation.
Okay, yeah, because and again, that's why we tell people when you're investing to make sure you look at all the details. I'm thinking, well, gosh, there's a lot more games for the MLB. How can they be paying less? But you're saying it may not be all games. Could have been maybe 20 games.
Oh, they definitely didn't have all games. Yeah. I know that for a fact. And I know the MLB in particular, they kind of came out with the Padres direct pass. Like you could just buy Padres baseball and that was it. So I think they're kind of trying to make more of a direct play. And I think NBA is trying to do that as well. NFL has not done that yet. I know that for a fact. Yeah. So I don't know, maybe the MLB is trying to go more that route than kind of packaging games and slicing them up. But it didn't appear that ESPN's package with the MLB was
a full package.
That large,
right.
Yeah.
And this is what we tell people all the time. We try to point in the right direction, do your full research, because, again, there's so much information out there. You can't just read the headline and say, oh, yeah. You got to understand the details.
Yeah, absolutely. And, I mean, we're talking about some major sports here, but there's another one, too, that I was shocked by. This Formula One car racing over the last 6 years has seen viewership double to 1.1 million viewers in a season. Now, you compare that to the NFL, that's very small scale, but I'm like, that's not bad viewership, and it's really kind of catching on. We'll see kind of how this occurs over the next maybe 6 years. They're going to double again to 2 million people, maybe. But the Liberty Media, who owns F1, they're trying to get a rights package between $150 to $180 million a year, and frankly, all they're hearing is crickets. And they seem to be a little bit aggressive here, as research firms estimated that it's worth over $100 million, but not at that $150 to $180 million. I think, again, these TV network companies are like, we're not going to overspend here. We've maybe overspent on some other deals. We got to be more cautious.
Right. And again, the F1 is how this kind of came up, seeing what's going on, that they're not getting what they want. And I have to say, you brought up NFL. I'm a car guy. I love cars. I love going fast. But to watch a car go around and around and around, like and I hate to say it, many times you're waiting for the accident because you want some excitement. And it's just, I understand why F1 Formula Racing is exciting. You go see the cars, you go to the movies. I mean, car movies generally get a lot of people to watch them. But to watch the actual race itself, and I know there's diehard race fans, but there's just not as many that would watch basketball, baseball, football.
And I think F1's more exciting personally than NASCAR, because NASCAR, you're just going in a circle. F1, I think, is like more through, like that's what was in Las Vegas. Like they put it in, I think, harder tracks, so there's more excitement, I would say, than NASCAR. And again, people are like, oh, what are you talking about? I love NASCAR. I'm like, I don't know. It's not for me, I guess.
It's still car racing. You see, and they do go through chicanes. They do all this different thing on Formula One. They're going through the streets. So, but still, they're just driving fast. And there's,
I totally agree. I think it's just going to be really interesting to see how all of these TV networks, and I mean the big tech companies too. You can't forget about Amazon, Netflix, Apple's in this game here too. Obviously, Alphabet, how they're going to kind of face these different sports deals as they kind of progress. And again, new sports like F1, who's going to want that deal in the long term?
Yeah, and we talked too about Netflix. Netflix, they're the big guy, but they kind of looked at it. About 75% of subscribers already watch F1, so there is no benefit for them. And it's going to be changes going forward. I mean, this whole TV situation is changing. Streaming is changing. So
sports are changing. The sports games aren't changing. But the rights to the sports are changing.
To it. Who's going to pay for it? How to pay for it? How to stream it? How to see it? So there's a lot going on there. It's a changing environment in the sports entertainment viewing world.
Absolutely.
Okay. Well, shall we move on to our first company for the day, NVIDIA?
Let's jump to it.
Yeah, because NVIDIA's been, I mean, gosh, I know you'll say what the high has been on that company, but it's really, I know, come down an awful lot. And now it could be a buy. So let's look at NVIDIA. Their symbol NVDA. They're in the industry of semiconductors. Not many people shorting this. Only 1% short on the float there. No surprise there. This is surprising to me. The PE ratio is now 34.5, below the industry at 38.7. I remember the PE. Was the PE over 100 at one point? It was ridiculous. So,
I mean, They had great earnings growth, and then obviously the stock price pulled back a little bit. So, I mean, it's definitely not what it was.
Yeah, better for the buyers, we believe. Price of sales is still high, though, 19.3 versus 8.6. We do see price of book value of 31.3 versus 7. Price of cash flow 39.2 versus 24. Those are still pretty high. The PEG ratio does look good, though, 1.2 versus 16.7. So it does show you're not paying very much right now on the predictability of the company for the future earnings. So we'll see how that changes. The earnings over last year, up 147%. The industry was up 44%. Sales for NVIDIA over the last year up 114.2%, above the industry at 91.9%. The 5-year estimated growth on the earnings from the analysts has actually come down. It's still attractive, 20.2%, but that compares to the industry at 18.3%. So I think at one point that was like 40 or 50, I believe. It was crazy. They do not pay a dividend. Wait, no, they do pay a dividend. Not why they're doing this, I have no idea. They pay a 4-cent dividend. It doesn't even register for a yield.
Well, if you look at it, the stock price is around 100, so it's 0.04%.
Yeah,
if you want to really get technical with it.
Well, they stop one place past a decimal point there. So yeah, not even worth looking at that dividend. Why even bother? We do see on the balance sheet current ratio 4.4 versus 3.3. So very, very good on the liquidity side. Debt to equity on 0.1 versus 0.3. That's a positive. Not much debt on the balance sheet. Looking at the net profit margin, this is phenomenal. 55.9 versus 22.5. I do believe we'll see that net profit margin decline going forward. I think I have some information on that. Return on equity, 91.9 versus 57.2. These numbers will be coming down. One I did notice, too, their free cash flow is $60 billion. So they do have a lot of free cash flow, but I believe going forward, that will come down even more. What do you got for your numbers?
Yeah, so current price here for NVIDIA, it's $101.49. Here's that 52-week high you were curious about, $153.13. So, I mean, this once very loved company has definitely pulled back, fallen a little bit from the graces there. But, I mean, still, the 52-week low is $75.61. And, you know, you can't knock anybody for holding NVIDIA long-term 10-year return, 18,327%. So again, if you've held it, you bought it back then, congratulations. You've done very, very well. Question is, do you buy it going forward? And unfortunately, I go forward to January 2027. I see estimated earnings per share of $5.69. Gives it a target sell price of $94.45. So it's still below that current level. But gosh, with all this market kind of concern, with the concerns over tariffs, I mean, this is one thing we love about being value investors. Is you might be able to pick up a company like an NVIDIA that frankly is a great business. I mean, what Jensen Huang and the company's been able to do is phenomenal. And we might see this company dip into a value opportunity.
And I've been reading that there is a slowdown on the AI side, which could cause NVIDIA to fall more, which could make it a buy for us down the road because they're not going to go anywhere, but they were way overpriced. I look at the earnings of the 569 you talked about, 45 analysts, which is a lot. But the high is 780 to low 480. So there's a lot of variability in this. And there, we'll watch it, see how the tariffs unfold. But this could be something that could be a potential buyer.
Well, what's really taken down the stock this last week was concerns over exporting licenses. And actually, in a filing, the U.S. government told NVIDIA it would require a license to export the chips to several countries, which included China. And the H20 chip was actually specially designed by NVIDIA to sell to China in compliance with U.S. export restrictions. And it generated the company between an estimated $12 and $15 billion last year. I looked at their total sales. It was around, I think, about $130 billion. So, I mean, it's about 10% of their sales. That's a big question mark. And they had to take a $5.5 billion charge tied to exporting those H20 graphics processing units. So, I mean, there's some questions here where, again, maybe there's a little bit more of a push lower because of this. So, the story's, I don't think, over with this trade war and how it kind of plays out. And, again, maybe you pick up an NVIDIA on discount.
And I'm just looking, you just get the price. Wow, the high was 153 on the stock price. So you're down a big amount from that. Needs to fall further for us to get really excited about a buy. But, with all the differences going on in trade wars, you never know.
Yeah, you never know. And as you said, there's always potential competition. I mean, AI, there's still question marks around that. And, NVIDIA kind of came out of nowhere. Is there somebody else that's going to come out of nowhere and dethrone them? It's a lot of question marks.
Yep. Well, let me promote the newsletter. I forgot to do that. The newsletter goes out every Friday at 5 o'clock. I'll go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You'll see the Apple credit card is up for bids. Buy now, pay later loan volume skyrockets. Is Kathy Wood still worth listening to? We got some good stuff there. Employers are still wrestling with playing for weight loss drugs. Weight Watchers has slimmed down too much. And are you thinking about raising your own chickens to save the cost of eggs? We'll talk about that. And we do have companies coming up next. It'll be Hertz, CarMax, and Dow. All right here on the Smart Investing Show. Brent Chase. Stay with us. All righty, welcome back to Smart Investing Show. We're going to talk about coming up the company Hertz, CarMax, and Dow Chemical. But before we dive into those three companies, we're going to talk to our financial planner, CFP Harrison Johnson, about why insurance is a poor retirement vehicle. I've known this for years. People still do it. I don't understand why. Maybe you can say some things to people like, oh, I'm not going to do that. I'm going to get rid of my life insurance.
And in this case, we're talking about life insurance, cash value life insurance specifically. So whether it's whole life insurance, universal life insurance, index universal life insurance, variable universal life insurance, there's a lot of different types, but they all work similarly to each other in the fact that they supposedly build cash value over time. And on the pitch of it, it sounds attractive. You get tax-deferred growth. You get access tax-free to the money through loans. There's a death benefit. There's no contribution limit, so you can put as much money as you want into them.
I just want to have you reemphasize tax-free benefit through loans.
Through loans.
I think a lot of times that part is left out. I'm sorry.
And I mean, it's not unlike a reverse mortgage, who, a lot of people have a very negative connotation toward, because essentially what happens is you build up cash value in these things, and then you use the cash value as collateral, and then you get a loan from the life insurance company, and you technically don't need to pay it back. But if you don't pay it back, that loan just accrues interest inside of the policy. And if that loan balance ever catches up with the cash value that you have in there, the policy lapses, which can be a huge tax event. So that's what you're doing is you're taking a loan. So reverse mortgage is taking a loan against the equity in your house. A home equity line of credit is taking a loan against the equity in your house. You can set up a securities-backed line of credit, which is taking a loan against the equity that you have in a stock portfolio. So that's what you're doing is it's tax-free because you're borrowing money.
Right.
And when you really come down to it, the main reason why these things don't work is because the cash value just doesn't grow that much. So the cash value, it's meant to grow. It grows tax deferred if you're not withdrawing from it, but there's cap rates, there's participation rates. If it's tied to an index, you don't get the dividends of that underlying index. If it's like the S&P 500 or the Russell 1000 or whatever it is. And then the main one is there's all these extra fees inside of these policies. So there's administration fees, there's premium fees, there's cost of insurance, with the big one being the cost of insurance, because with life insurance, fundamentally, there's a death benefit. So if you die, death benefit gets paid to your beneficiaries. But every year you get older, the cost of that death benefit gets larger because you're more likely to die the older that you get. So all of those fees come out of the cash value that you have. And so, you get to a point in retirement where you want to start borrowing against this thing. Well, those fees are not going to stop. You're still going to have cost of insurance fees. You're still going to have administrative fees. And so if there's not enough cash value in there, it makes it more likely that the loan balance is going to catch up to the policy and then cause the thing to lapse.
And Chase, I'll give you a second here, but I do want to ask real quick, because you talk about the expenses. I've not heard about the commissions, which I've seen commissions that are very high in the beginning. And sometimes they have these residual commissions go on for 10 years after they sell the first policy.
In many cases, yes. With the permanent policies, the big commission is up front. So how well the policy performs doesn't necessarily matter to the advisor selling because they get most of the money up front. But you're right, there are residual commissions based on extra premiums paid by the policy owner over time. So paid up front, you can continue to get it paid. And, the main selling point, again, of this is the tax-free income you get in retirement, which is not unlike what a Roth account does, whether you have a Roth 401k, Roth IRA. And, I'm not talking about the difference between a traditional and Roth contribution at this point, but with life insurance, you pay the premiums with after-tax dollars, and then you can borrow against it tax-free, which is exactly how a Roth contribution works. But from an advisor's perspective, if you could have somebody put, let's say, $1,000 a month into a Roth IRA starting at nothing, or pay $1,000 a month in premiums to the life insurance, you're going to make, as an advisor, basically nothing on that Roth IRA, charging a management fee, but you might make $7,000, $8,000, $9,000, $10,000 in commission on that life insurance. So, obviously there's going to be a conflict of interest and bias there from the advisor standpoint. So we're advisors, but, we want to make these things apparent. This is how it works. And the cash value, again, bottom line, just doesn't grow very much.
And I think we always tell people, one of the best things you can do is put money in your 401k. We don't make any money off of that when we tell people to put money into a 401k. And I think a lot of life insurance sales people know that. And it just blows my mind. Kind of use that example of a Roth IRA / Roth 401k versus the cash value life insurance. I mean, so you're telling me essentially you could what $23,500 into a Roth 401k plus then $7,500 now into a Roth IRA. So you're telling me you have more than $30,000 going into a Roth 401k Roth IRA? There's no way that's the case, because that is a far better investment than cash value life insurance.
I do have to just interject. I know somebody's going to say, but wait a minute. What if I'm married with kids? I need that death benefit. What do you do then?
Well, you get a term policy that costs, $20 a month or something like that.
Just want to make sure we cover that base.
So, yeah, we're not saying that life insurance is a bad thing, because there's a lot of different ways to insure, whatever it is. And I see a lot of people that get life insurance through their employer. So they get the coverage that they need through the employer. Maybe they add some extra term insurance on top of that. But from a premium perspective, term insurance is so cheap. You can get $1 million, $2 million of coverage for $20, $30, $40, $50 a month, where to get a permanent life insurance policy in the $1 million to $2 million death benefit range is going to cost thousands and thousands of dollars per month. And a lot of that is going to fees, and it's sold that it can build up cash value. But again, the cash value doesn't grow. I talked to somebody this week, and 25-year-old they didn't really have a choice in the matter because it was when they were a baby, but their family member got them a life insurance policy when they were born. And so this policy has been paid into it $300 a month every month for the last 25 years. And right now there's cash value of $80,000 in there. Doesn't sound bad until you do the math and you figure out that $90,000 has been paid into that policy. So after 25 years, the cash value inside of this thing is still not caught up just with the contributions that you've put into that. Now, compare that to if you had put that into something that's made 8 to 9% per year invested in the market, they'd have close to $300,000 invested. So again, when you compare the cash value growth in these things to what other opportunities that you have, it just doesn't compare.
Well, and I mean, what the death benefit was $900,000?
About $900,000 in this case, yeah.
And I'm pretty confident by the time, let's say, this gentleman is 50, 65, 70, hopefully he hasn't passed away by then. That $300 a month is going to be a heck of a lot more than that death benefit plus the cash value.
Yeah, go ahead.
I was going to say, and I'm wondering too, because there is such a thing called insurable interest.
Mm-hmm.
How is a 1-year-old worth $900,000? I mean, again, they're precious as your own child, but there has to be a financial benefit.
Right. And I mean, it is kind of weird how you can get around that, because you're right. For someone to get life insurance, there has to be a need for them to have that level of death benefit, where I don't know how you legitimately justify that a 3-year-old needs close to $1 million of life insurance. But you can say whatever you need to. You can push it through underwriting, and obviously it happens. I mean, you see commercials for like the Gerber baby where they have whole life insurance and stuff. And, I think that's not what you want to do. If you want to help out your baby, invest in something that actually grows.
Yeah, and not savings bonds.
That's another thing we see a lot too.
You need to do
savings
one of that
bonds,
one.
2% for 30 years. No, you don't want to do that either.
We got to let you go, but real quick, just to make sure there's no confusion, look in the camera. Should they buy life insurance for retirement benefits?
Do not do that. Not for retirement benefits. Buy it for a death benefit purpose, but not for term. Do not buy life insurance for an investment retirement vehicle.
Harrison, thanks very much. We appreciate it.
All right. Thanks, guys.
Okay, bye-bye. Again, it's Harrison Johnson. He is our financial planner, CFP at Wilsey Asset Management. If you want a free consultation with him or talk to him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You can answer all your questions. You can talk to him more about doing a true financial plan, not sold by a salesperson to make a big commission for selling something.
We were just talking about this the other day, and Harrison's like, that's a good topic, so I'm going to talk. It just blows my mind, and it just drives me crazy when you look at the numbers on these. The returns are just terrible.
And as Harrison was talking, I was thinking, I know we got to get to our companies, but I was thinking, I guess people don't get it because, on average, they're not good with math and numbers and compounding.
Well, and you're giving them such a complicated piece of financial product, essentially. You're giving them such a complicated financial product that they don't know what the heck is happening.
Yeah, like, $900,000 death benefit. Yeah. Ooh, I'm going to have $80,000. Woo. But they never do the math to figure out that's a negative return. So, well, let's move on and talk about a positive return. If you held Hertz Global Holdings, if you knew what was going on there, we're going to go over that. Symbol HTZ, they're in the rental and leasing services industry, 43% short on the float side. That's a lot of short people, or a lot of people that are shorting, not short people, but people that are shorting the stock there. No PE ratio. Means over the last 12 months, they had no earnings. Industry was up 42. Price to sales was very cheap, 0.3 versus 1.3. Price to book value, 16.6 versus 2. That's very expensive. Price to cash flow did look good, 1.1 versus 6, but no PEG ratio. Now, over the last year, there was no earnings. Industry was down 13% over the last year. Sales fell by 3.8%. I love this from the analysts, the 5-year earnings per share growth estimate from the analysts. They expect earnings to fall 61.3%. Industry was down 10.8 was the expectation there. Hertz does not pay a dividend. Let's take a look at the balance sheet, see if there's anything there. Current ratio 0.7 versus 2.1, so a little bit concerned on the liquidity of the business. Debt to equity 120.3 versus 6.2. And Chase, I'm wondering, I don't think this is like a car dealer because they don't have any financing, but 120 is not too bad. I'm okay with that. We do see a net profit margin. Here's a problem: a negative 31.6% versus 4.8. Gosh, I rented a car not long ago. How are they not making money? I mean, they charge a lot for these cars. I think like $90 a day for the car I got. Jeez.
Yeah, that's pretty surprising.
Yeah, return to equity a negative 1,800 versus positive 16.3. Not looking good here. I know you got some stuff to talk about here, and then also too the numbers going forward.
Yeah, I mean, we saw what was called a short squeeze this last week, where people definitely were covering, and a big reason for that was actually Bill Ackman's Pershing Square. They took a sizable stake in it, and I think it surged like 56% on Wednesday, and then it looks like it was up 44% on Thursday. Obviously, markets closed Friday, so I mean, basically 2 days in a row up. We'll call it 50% each day. I mean, year to date, the stock is now up over 100%, but that's really only come this week. So,
yeah, 125%. I see.
It's interesting to kind of look at these numbers here, and looking at Ackman, I think the reason it surged so much was he had about a 4.1% stake at the end of 2024. But now that's actually closer to 20%, and he is the second largest shareholder. I was trying to find who the first largest one is, but he's now the second largest shareholder. So, I mean, he now owns about 20% of those shares. I think that's a big reason why he saw such a big short squeeze was they're like, oh, shoot, like if he wants these shares, like he can buy up a good chunk of the outstanding shares.
Did you see why he's doing that? Because I don't see any reason.
I mean I was trying to find something, and it didn't look like he really released anything just yet on what he sees in it. But
and, he's been underperforming dramatically on the markets, which are
yeah.
doing poorly. So I don't know what he's grabbing for here.
I'm not sure. I mean, let me look at the numbers, see if there's something that he sees that we don't. But, looking at the current price, it is $8.24. I mean, 52-week range, the low's $2.47. The high's $8.74. I'm not sure, essentially, how much he benefited from the short squeeze. But the problem is if he starts selling shares, let's say, I mean, the stock's going to plummet. So he's going to have a hard time getting out of it on the other side, too. So he could almost be trapped in this. This has to work out. It's not. Let's say he even booked a nice profit on these shares. Well, if he gets out, he's going to lose that profit. So the only way this works out for him still is Hertz has to be a viable investment for the long term, owning 20% of the business. And unfortunately, looking forward for the company, I go to December 2026, I see estimated earnings of just 19 cents. I mean, it gives us a target sell price here of just $3.15. And I was kind of hopeful for this because, we talked years ago.
You were hopeful for Hertz?
Yeah, I thought maybe there'd be some opportunity here.
Oh, after you saw this.
Yeah,
right,
yeah.
Right.
When we say we're going to look at Hertz today, I was hopeful that this could be a good buy.
I got you.
Big reason is, a couple of years ago, I was like, these car rental businesses, they're dying. There's no way. And I was a big Lyft, Uber user. I haven't used Lyft or Uber in years. I mean, having a baby, you can't really use Lyft or Uber. So, I mean, you go places now, you have to rent a car.
Right.
It's going to be the most convenient way, in my opinion. So I'm like, I don't think this business is going anywhere. I'm just shocked at how unprofitable it is.
We have talked about how less people in America are having babies. So there is, you're one of them. I don't see
one of the few. Right. Not that extreme.
Right. But I mean, it could be still hurting the rental car business. But what I see here, are you done with your numbers? I think you were done.
Yeah.
Because what I saw, that 19 cents was, we always talk about on a tight range. Well, there's 5 analysts. Somebody expects them to lose 29 cents, which I think I might agree with more than the guy that says 76 cents. So that's the average. If you pop out the high and the low number, you may not even get a profitable thing. So I'm very curious. Ackman, and he's supposed to be a value investor. I don't know what value he sees.
A value investor. He like Chipotle. I mean, he's like some other stuff.
Yeah, that's true.
I don't think there's been one investment that he's done where I was like, that's a good idea.
Yeah, he's not a value investor. I think I get confused with somebody else that's a value.
Yeah.
But
I think you're David Einhorn.
Yes, that's what I was thinking of. I haven't heard from him in a while.
Yeah, he's been pretty quiet. I know he had a couple things at the beginning of the year, but I know he liked like CNH Industrial. Like there's some that he had some things that I liked, but yeah, Ackman, I'm like, I don't think there's ever been anything that I've been interested in. And his performance, as you said, has not been impressive.
The guy's a billionaire.
Oh yeah,
and we should do a hedge fund. They make so much more money than we do.
Well, the thing I think with the hedge funds is he was hot for a little bit, and don't get me wrong,
Right.
like he had, I think, a stretch of time where he was outperforming and he was doing phenomenal. So you get to that short term, kind of viewpoint. I think people that can capitalize on that, we didn't get to talk about it today, but like a Kathy Wood, like a Bill Ackman, you don't need to be good for a long term. You need to be great for a short term, and then you can make a ton of money. And that's again, not our philosophy. So I don't think we'd be successful as a hedge fund because we never have these periods where it's like, we made, like Kathy Wood, I think in a couple of years, made like 200% or something. But we're never going to have that as value investors.
We've had years where we've done extremely well, triple digits, but it's just, you got to have everything just right for that. We won't leverage like they do.
We're not ever going to be, I'm sorry, Kathy Wood, Bill Ackman, we're never going to have a period of outperformance the way that they did.
We can make a few $100 million a year. You sure? I don't know.
We're gonna have to take some big chances. Yeah. I think it's crazy, and I think this Hertz company is definitely just not worth investing in, especially after this 100% gain in 2 days.
Yeah, well, then, bottom line, don't invest in Hertz. And
you're gonna hurt if you invest in Hertz.
I've been doing this for 40 years. I like the way we do it. It's very calm. We grow very nicely over time, as opposed to these big peaks and valleys that these hedge funds go through.
Well, long term is, I think, so much more valuable than being right for a couple years than being wrong for a decade, we'll call it.
Yeah. I'd rather be right long term than right short term than wrong. So let's move on to another company here, CarMax. And I love their symbol, and I guess the C was gone because the symbol for CarMax is KMX. They're in the auto and truck dealership industry. They have a little bit high float here. It's about 9%. So there was some concern there for some shorts thinking this stock could fall. They do have a PE ratio, which is 20.1. That I say that because the industry has nothing. Price of sales 0.4, same as the industry. Price to book value 1.6 versus 2.5. That is good. Price of cash flow 16.2 versus 11.8, and we see a PEG ratio of 3.3. Nothing there in the industry. We do see over the last year, the earnings for CarMax did climb by 6.3% when the industry fell by 16.9%. Sales did fall by 0.7%, but yet the industry grew by 9.5%, so kind of a flip-flop there. They do see from the analysts on the 5-year earnings per share growth estimate increase of 4.8%, which is far better than the industry expectation to lose 31.6%. They do not pay a dividend. Let's take a look at the balance sheet here. Current ratio 2.3 versus 1.9. That's positive. What is not positive is the debt to equity 3.1 versus 2.5. This is what I'm kind of talking about. I think CarMax, I believe they do carry the financing.
It's possible. Or they could have some type of, like, I know dealerships have lot financing where they have a certain type of financing on the vehicle while they're working on selling it. So there might be some distortments to that balance sheet.
Yeah, because that's a little bit high in the debt to equity. So again, we tell you have to kind of look at that a little bit deeper. We do see a net profit margin of 1.9%. That is just under the industry at 2.1. Return on equity is 8% versus 14.7. Return on invested capital, which includes your debt, not very good at negative 0.9%. So I'm not getting too excited here unless you got something that you can convince me that there's something else here. But I'm not seeing anything.
Well, let's take a look at the numbers here. Current price for CarMax, again, their ticker symbol KMX, $64.59. 52-week range, I mean, this stock is definitely fallen. The low here, $63.23. The high, $91.25. I see year-to-date, the stock is down. Oh, gosh, of course, it's loading on me here now. Unfortunately, it looks like the stock has fallen. I can't give you that exact amount. But
21%.
Perfect.
Yep.
21% exactly. Now, of course, it loads
us,
right after you tell me.
And you're going to give us a 10-year? You got the 10-year loaded there?
I'll let you give it because my computer's being a little bit odd. So
I got computer. I had them in the beginning. Yeah. You got them now.
Sometimes it happens.
And you had a 10-year return, negative 8.5%.
Interesting. I thought it might have done okay. But looking forward, I'm going to say the numbers look okay. And I say that because the estimated earnings per share for February 2027 is $4.35. I mean, it gives us a target sell price of $72.21, which is an estimated return about 12%. So that would put this company in the hold category for us. It would not be a buy based off the numbers. But who knows? I mean, the stock could fall further. And we did see a part of reason for the tumble, we'll call it, over the last couple weeks. They did report earnings of 58 cents per share. That missed the estimate at 65 cents. So they did have an earnings miss, probably had some increased uncertainty with the tariffs. The market probably didn't like that. So I don't think I'm high enough on this stock to buy it at these levels, or even if it dipped another 5, 10, 15%, I still don't think that would entice me. I'll tell you, I was somewhat excited by this because, we think with these tariffs, maybe there'll be more of a push towards the used car market. And I thought that might benefit CarMax, but I just don't think the valuations are worth it at this level.
And I think that would work. And one thing that is going to happen is that and we saw this during COVID where you couldn't get new cars, but the price of used cars went up dramatically because simply the main economic thing that we talk about is supply demand. Supply is low. I mean, if demand is high, supply is low, prices will go up. So I think that's going to happen in the used car market. What could help a CarMax, could help people want to sell their car, good time to sell it. The thing is you got to buy something else unless you have, like me, 7 cars. But
I was going to say the only way it really benefits CarMax, and this is a terrible business model, is to have a ton of inventory. Because if you have a ton of inventory, used car prices go up. You don't do anything. You know?
That's true.
You just got an automatic increase. You didn't have to manufacture the car and import them. It just goes up. But unfortunately, that's a terrible business model. You have too much inventory that you don't want to operate that way. So as you said, the problem with CarMax is while they might be selling used cars at higher prices, they're also buying used cars now at higher prices.
Maybe not, because the average consumer may not realize that with the tariffs, their used car is worth more. Yeah. So they could go to CarMax like, oh, that's all it's worth. Oh, okay. So
and it's going to come down to the spread. I mean,
Yeah.
if they are able to sell the used cars at a higher price than what they're buying them, and that increase is substantial, I mean, yeah, it might work out for CarMax quite nicely.
Yeah, but nothing too exciting.
No, again, the numbers aren't enticing. I was kind of hoping maybe you could find this around 10, 12 times earnings, but we're getting around 14, 15. Just too expensive.
And I thought I had on here, gosh, we are having computer troubles here. I thought I had on here Dow Chemical, but I don't see that. So I had to manually input this symbol here. What is going on today with our show?
Well, while you're inputting it, you know, I thought this was an interesting one. The chemical stock actually slid more than 4% this past week after a downgrade to underperform from buy at Bank of America. The investment firm said Dow is facing a perfect storm of negative factors, including a weakening economy and higher barriers to trade. And I didn't think about this, but I know chemicals are actually a highly traded product, commodity, whatever you want to call it. So I'm curious how the tariffs will impact this business. Kind of a little bit front running here in terms of looking at the numbers, but that is definitely a consideration you need to have before buying this.
And you brought up said something that's very exciting to me. They downgraded or pushed it down because, a weaker economy. Well, as we talk about, we like these short-term things. We think that longer term we're going to be fine. This creates a buying opportunity. And yeah, maybe you buy, and I'm not worried if I buy something that goes down 5, 10% for 2, 3, 4 months. I want to know where it's going to be 12, 18, 24 months from now, what I'm more concerned about. But look at the numbers at Dow Chemical. Gosh, we're running out of time here quick. Short float is 4.2. No problem there. Institutional owns 68%. They do have a PE ratio of 17.9 versus the industry of nothing, and they are in the industry of chemicals. I want to point that out. Price to sales 0.5 versus 0.6. Price to book value 1.1 versus 1, and price to cash flow 6.8 versus 5.6. PEG ratio 0.7, very good. The industry's at 28.4, so I'm kind of liking a little bit what I'm seeing here so far. Over the last year, earnings were down 6.5%. That sounds bad, but the industry fell by 50%. Sales down 1.3%, same as the industry. Now, here's what I'm talking about. The 5-year earnings per share growth estimate for the earnings from the analysts, they're looking for growth of 35%. Who really cares if the next 3 or 4 months they slow down a little bit because of a little slowdown in the economy? Industry is only 8.9. Holy, wait. I don't wear glasses, but I'm seeing a 10% yield.
Yeah, I had to check. I was like, what?
Wow. I mean, I would be cautious that could be cut because I do see it says 178% payout ratio. So that could be cut, but gosh, that's a nice yield. I mean, geez, 10%. What else I want to look at here? The balance sheet, current ratio 1.6 versus 1.8. That's good. Debt to equity 1 versus 0.8. That is positive. They have a net profit margin of 2.6 versus a negative 0.3. Return on equity is 6.4 versus 3.3, which that was higher. While you're doing your part, I'm going to look at the cash flow statement to see if they got cash flow, because maybe they don't have to cut that dividend. I'll see.
Yeah, I mean, that would be great if you could lock in a 10% yield and they don't cut it. But we'll look at the current price here for Dow Inc. Again, their ticker symbol Dow, D-O-W, $28.15. 52-week lows, $25.06, and the high here, $60.19. Yeah, the 1-year return, gosh, it's down 50%. Year-to-date, down 30%. 10-year return, Not there because of some interesting kind of merger situations that happened, but 5-year down about 15%. So, I mean, the stock has not been a great performer, to say the least, with this big downturn. But looking out to December 2026, I do see estimated earnings per share of $2.06. That gives us a target sell price of $34.20. A little bit disappointed, as that's only about 22% away from the current level. I was hoping that this would kind of register, but it appears that the earnings and likely the costs that go into this is just so cyclical because, earnings growth next year 46%, following year 34%. I mean, it could just be at a trough, and frankly, it could be a great time to buy, but we just can't justify it at this rate.
And I did look at the cash flow statement, and I was trying to get the free cash flow, but I couldn't find it. But the cash flow from operations over the last trailing 12 months was $2.9 billion. It has been higher. 2023, the full year was like $5 billion. 2022, $7 billion. So it's definitely worth looking at.
Yeah,
so,
looking at it.
Gosh, that closing bell came quick. Thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss more detail your investment needs, have other investment questions, give myself a call or Chase a call at 858-224-0004 or go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great information there. You can sign up for the newsletter right there. We got podcasts here. We got so much information to make you a smarter investor. Again, smartinvesting2000.com. Stay with us next week. We'll have another show. So we've been doing this for about 20 some years. Have a good day.